Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited you're joining me for this live webinar that we do every Tuesday, where we go over the ins and outs of passive investing, specifically passive real estate investing, so you can go into your next or first deal with confidence. So if you haven't done so already, check out passiveinvestingwithwhitney.com. There, I have some free goodies for you. Also, you and I can have one-on-one time to discuss how passive real estate investments can help you meet your passive investing goals. And you can see our live open deals there. So check out passiveinvestingwithwhitney.com. Today, we are going to talk about how the capital stack in short, whether it's you're investing in debt or investing in equity, we're going to discuss which part of the capital stack is right for you. And if you're wondering here, I don't know what a capital stack is, don't worry, we will answer that question as well. But if this is the first time that you and I are meeting, again, my name is Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And this is the whole reason right here on the screen that I invest passively. Now, I still do a little bit of active investing. Okay, I run, do a lot of active endeavors, but it is how quickly can I take those chips off the table and move them into passive investments that do not require my time and attention. Okay, that is what's unlocked financial freedom for myself and for my family. Now, my investing journey, just because we're at financial freedom here in 2024, that doesn't mean it has been a smooth road or been an overnight success. I actually started investing in real estate back in 2002, and I've had my fair shares of up and downs in the market. Now, I started off living, flipping, and house hacking, then scaled a single family rental portfolio, then bought multifamily actively, as well as trying to figure out how to place capital passively. But really, when it comes to unlocking those golden handcuffs, it's the passive side of our portfolio that's been able to do that for us. Okay. Okay, sure, you can build quite a bit of equity actively investing, but you're going to be tied to a phone, tied to a computer. It's not what's going to let you, unless you're super great at scaling systems, scaling people, scaling teams. It is what's going to get you that financial freedom, okay, and the other freedoms in life. It's going to be the passive side of your portfolio. And my husband and I, we've been able to do that with our holdings here that you see on the screen. And really what that has allowed us to do is to get 100% choice and control on how we spend our time. And we can actually help you do that here at PassiveInvesting.com. With over 308 million deployed through our rehab wallet loans, 1.4 billion assets under management, and strong for full cycle returns for our investors. Okay, now today's webinar is for educational purposes only. So we're not going to talk about financial advice, legal advice, tax advice. If we talk about anything like that can be true like that, make sure to consult with your investing team before making any sort of investing decision. All right, so our conversation today is what part of the capital stack is right for you, okay? Is it debt side? Is it the equity side? Well, let's actually demystify what a capital stack is. And here is a great visual on the right-hand side of the screen. If you guys are listening on your favorite podcast player of choice, you can find this video on our YouTube page at passiveinvesting.com. All right, so then capital stack is actually the different layers of money that go into purchasing an asset, okay, like real estate or even like business, okay? And there are different types of capital stacks for sure out there, and each deal is going to be slightly different, but this visual is going to break down the four main buckets of money. One, we've got our senior debt position, okay? That's usually your bank loan, or some sort of like agency loan. Then you're going to have a layer on top of that mezzanine debt. Maybe you have a HELOC or a second loan or, some sort of promissory note, some sort of like extra note in there, and that can operate like a second loan. And then those two layers generally make up your debt position. Okay. Those are going to be the lowest risk and generally oftentimes receive the lowest returns. So we're going to bust that myth today. And then we flip to the equity side of things. Okay. Next, after, layer on top of your mezzanine debt, we're going to have your preferred equity. Okay. Your preferred equity, again, that's a more secured position and sits right behind the debt. Okay. It's the first equity position to be paid off. And then your common equity class. Okay. This is where a lot of investors sit, as well as the general partners in most deals. Okay. The higher up you go in the equity stack, the capital stack, especially venturing on the equity side of things, you have to solve more business problems, meaning you're going to be taking on more risk, because guess what? You're solving a problem, right? And by taking on more risk, you should be able to get greater returns for solving that risk as well. Okay. Now, we have other videos that show you as a passive investor how to mitigate risk when you're investing on the equity side of things. But for today's conversation, we're just going to demystify the different layers of the capital stack and which one's right for you. Why is it important that you as a passive investor fully understand the different layers of money and what the kind of the pros and cons, the risk rewards are in each layer? And it's because most passive investors that I have encountered, especially if they're new to passive investing real estate, they think that even when they're in an equity position, okay, a limited partner in a deal, they're just lending the deal money. They think that they are in these lower risk, low return positions with the senior debt, with the mezzanine debt, and that's simply not true. Okay. There's two ways to figure out where you are in the capital stack. One, ask, okay, the operator. Two, look at the private placement memorandum, okay? It will define where that offering is in the capital stack. And that will determine what kind of relationship, risk-reward relationship you have in the deal, okay? Debt is going to have a different risk-reward relationship than equity. And quite frankly, your preferred equity class generally will combine some sort of debt position and equity position. So things can, we want to make sure that it's outlined very well in the private placement memorandum. All right, so let's start going through some of the different layers. I'm going to start from the top going down. So we're going to look at that common equity position. Okay, that common equity position, it's the highest risk, highest reward position. The risk here is that generally when you invest in this position, say like you're going in on a express car wash deal, you're going in on a limited partnership on a multifamily, maybe a self-storage deal, mobile home park, whatever, you name it. You're going in partnership with the operator. Okay, so it's illiquid. Okay, so say I'm the operator, I'm saying, hey, Mr. Investor, do you want to go buy an apartment building together? I'll do the work, you bring the money, and we're going to split the profits. Okay, now it's going to take about 5 to 7 years to reposition this building. We're in partnership for that entire time. It's not like a stock where you can exit. Right? So the risks it's a liquid. You have to know the time horizon. Okay. And then the other risk here are the various business risks. Like you have to understand what that operator's business plan actually is. And is the operator equipped to pull that business plan off? Okay. Do they have the team, the resources, the capital in order to be able to do that? Do they have the track record and experience? Right? Now, the rewards is that you're taking an ownership stake in a piece of property. Okay. You're not holding the note as you would be in a debt position, but you're in an ownership stake. So meaning you get to, get all the upside on the deal. You get to capitalize on market inefficiency as well. So as that operator, and we're going to look at a few graphs here in a second so I can illustrate exactly what I mean by market inefficiency. You get to partake in the upside of the deal. And again, part of the reward is for solving these business problems, for capitalizing on market inefficiency, you get to participate on the higher returns for the deal. All right, now here is we're not going to dive in too much about like the markets and where we are in the market cycle. We'll save that for another masterclass. But I wanted to show you the general 4 phases of any market cycle. Okay, now And this is general market cycle, but we can take this and we can overlay it to real estate. We could overlay it to business. We could overlay it to the stock market. Not all the time do the markets, they tend to cycle differently in and of themselves as well. Every once in a while, sometimes the cycles actually overlay against each other. But phase one is the recovery. Essentially, you're coming out of a down part of the market cycle, okay? Your vacancy is going down. There's no new construction. Okay, so you get all this absorption of whatever units, your multifamily units, your self-storage units, okay? As you move into expansion, again, you have more declining vacancy, but you're starting to see new projects come online. Then eventually, and again, these cycles are long-term, okay? This doesn't happen in a year or two. This is like over 5, 7, 10 years. Then eventually you peak at the top of the market supply. Okay, this is where you hit hypersupply and you start seeing increasing vacancy in whatever your investment is of choice. And then you're still seeing some new construction, right? Because construction starts take a long time to undergo and execute. And then you hit oversupply, and then you start getting more increasing vacancy, and then your completions start being delivered, but you're bottoming out in a recession. Now I'm going to show you how this overlays with the debt cycles here in a second. Okay, so the common equity class tends to take advantage of this expansion part, recovery and expansion part of the cycle, okay? So if you are really matching up with equity deals, you love equity deals, this is the arena, the phase one, phase two, through the recovery into the expansion. That's whenever you want to invest in the equity side of deals. All right, so how does this overlay with credit cycles? Okay, so this is essentially the same, again, we're seeing our recovery here, our expansion here, all right? Credit tends to be, as we head into from hypersupply downward, this is where credit becomes less available. So if common equity, okay, tends to pair very well for investors that are looking to take advantage of that upswing in the market, people that are looking to take advantage of the downswing in the market should consider adding some of the debt tiers to their portfolio. And let's talk about those. And the reason why you might want to consider taking advantage and adding debt tiers to your portfolio is because less credit, bank credit, institutional credit is available. And so investors get to step in and take those rewards that the bank is passing up on. So now we did say preferred equity is on the equity side of the tier. However, it can be partnered with kind of a promise to pay or a quasi debt-like position. So I kind of put it in between these two. Do you invest in debt or equity? If you don't really know, preferred equity might be a good option for you. But the risks are they're limited upside, right? You're not going to be taking advantage of, or investing in the tiers that are going to get paid well for the equity growth, but you might be able to carve out some of that for the preferred equity position. There's an interest rate sensitivity here. So as interest rates get again, as debt becomes less available, bank debt is limited, people can command preferred equity position. But whenever bank debt, agency debt is plentiful, you're not going to see a whole lot of preferred equity deals. So if we backed it up right here, preferred equity really takes advantage of the hypersupply and the recession parts of the cycle. It is available in the recovery and expansion parts of the cycle, but a little less. Your banks are going to be, able to really compete here. All right. The rewards are that you get a risk-adjusted return, you have priority, position over the common equity class, and depending on how that preferred equity is negotiated, how it is structured, you might actually get a potential for a little bit of appreciation in the deal. Now, we do have a preferred equity deal that is currently open right now. It is our Alliance Fund. If you're interested in a preferred equity position, make sure to reach out to me at passiveinvestingwithwhitney.com or at whitney@passiveinvesting.com. Okay, then we have our promissory note position. Okay, the promissory note position, this is going to, if we go back to our capital stack, this is going to sit It's not necessarily mezzanine debt, but it's going to sit more in this mezzanine debt type position. Okay, it's a subordinate position to the senior debt. The other risk is that you do, when you invest in debt, you do take a credit risk here. Okay, you're lending money to a borrower. Like, you have to underwrite the borrower. You have to know, can they actually repay this debt? Now, promissory notes usually lock in for, say, 6 to 24 months. So there tends to be some illiquidity here. So they can, while they may not be completely illiquid, they have less liquidity than some other options I'm going to show you. And while you're taking this credit risk, that also could trigger a default risk. Should the borrower not be able to repay, there is a risk of default. Okay, so in that case, if if the borrower defaults, can you take over the project and see it to completion? All right, the rewards are this promissory note position. Like I said, it matches up, kind of with that mezzanine debt position. You're going to get higher yields here in a more secured position. So maybe the promissory note is secured by the business. Maybe it's actually secured by the asset that the business owns. You're actually going to be in a much more secured position. Most of the time, promissory notes have to be paid off. And I can speak in the case for us, the way we structure promissory notes. The senior debt, when the asset sells, the senior debt gets paid off. Then any other notes written to the business get paid off next before the preferred equity classes or even the common equity classes. All right, and we do have a couple open opportunities here right now. If you want to reach out to me, we have a promissory note in a medical facility and one in a multifamily opportunity as well. Okay, so then we've got our senior debt positions. Now, you might be thinking about your 30-year fixed Fannie Freddie type loans. Senior debt can also be, senior debt just means first position. For us, we like that first position on fix and flip property, specifically because you don't have the long hold times. Your hold times on those type of notes are going to be 6-ish months, maybe up to 9 months. And so they're going to recycle pretty quickly. The risk here is that you are in the lower layers of the capital stack, those base layers. So technically you get a lower yield than you could in the common equity classes. Okay. You do have limited upside because you're only participating in that debt position, not into, taking advantage of appreciation in the market. You do have a credit risk and borrower risk, so a risk of default here should the borrower not be able to repay. And there are, in some senior debt positions, there are lockup periods, okay? 6 months, 12 months, even upwards to 36 months I've seen. Now, the rewards are by adding in debt into your portfolio is that you're creating a layer, part of your portfolio is now dedicated to fixed returns, priority in repayment, lower exposure to market volatility. If you invest in senior debt in fix and flip loans, you're going to get greater liquidity. Okay, as the market shifts, you can be able to either as your financial shift, but also if you see other deals that come on the market, you've got money out of the bank, it's performing well, and you can take advantage of what the market's giving you. Also, in some of these debt positions, including ours, like our real estate debt fund, you can actually get compounding as well. And so this is where I know investors say, like, over the course of 10 years, how does me holding a debt position and allowing it to compound compared to, investing in a single family rented deal? Pretty comparably, because if you allow your investment in a senior debt position, especially in fix and flip compound, is say 8% or more per annum, that can equate to 17% rate of return at the end of 10 years. All right. Now, guys, I know this is a lot of information. I am going to open up the floor here to our Ask Me Anything part of the show. If you're interested in learning more about our investments in equity and in debt and how our investments can actually help you achieve your investing goals, check out passiveinvestingwithwhitney.com. There, again, I've got some free goodies for you, but also you can hop on a phone call with me, and I'd love to help you decipher how we can help you meet your investing goals. Stay tuned. If you're here live, we're about to start Ask Me Anything part of the show. Awesome. Guys, and I say guys in the very general sense, what did you love? What would you love to see? I see some like awesome, like some new faces here. What questions do you guys have? Go over to the Q&A box or to the chat box. Did I answer all your questions on debt and equity? If I did, amazing. But I have a sneaking suspicion some of you guys have some questions. This is your time to ask. Let's see. What is the cycle the real estate market is currently in? Awesome. So I'll go back. Let me share the screen one more time, because I always like speaking in visuals. So if this is the market cycle, okay, you can essentially overlay this to business, real estate, but I mean, not just real estate in general, right? Like multifamily cycles differently than self-storage, which cycles differently than mobile home parks, right? So you can't just say real estate in general. But so I'm curious, like if you have a specific asset class that you wanted to discuss, like if your question is centered around that. But right now, self-storage, in some markets and then you also get down to regional supply. Again, I'm going to do a whole webinar on like how to decipher markets, because real estate is super local. So if we are, in the West Coast, like in California, they've been, and I would challenge, some parts of, California has been in a recession for quite a while. Other part of the, Sunbelt states, they've been, 2024 is the year of hypersupply and absorption, especially for multifamily units. As we go into 2025, we're going to start bouncing out of here. And here, these run-ups take years. This is a long time. These run-ups take a long time to move into, whoops, hold on, I clicked. To move from this part of the cycle to this part of the cycle doesn't take that long. Like, it's like the law of like 3/4 are in the recovery expansion, okay? And then like 1/4 is in the hypersupply recession. Okay, so I feel like we've been moving through these two phases of the cycle for the past couple years. Okay. Oh, let's see here. It's not allowing me to open up my Q&A box. Exit real fast. Cool. All right. Okay. So question about debt funds. When people say you can invest in a debt fund, can you explain again? So a debt fund, so right now, again, I told, we deciphered that we're in that hypersupply recessionary part of the market cycle. Are we starting the hypersupply? No. Are we like through the recession? No. But bank credit has tightened. So we're all waiting for those the Fed to drop interest rates, because I think that's going to be, it's not to say that we're going to be through the recession, but that's going to trigger, a lot of lending to start happening. Okay. So right now, as we're in that what debt funds, what debt in general does very well, especially private debt, it takes advantage of that hypersupply in the recessionary part of the environment. Okay, banks have exited, institutions have exited, but the investor now gets to solve the problem. Okay. Now you could go out and write your own note, individual note. So you could start finding fix and flippers and write, invest in 1 or 2 houses, dropping, a couple $100,000. Or you could take $100,000 and instead of being diversified over 2 deals or 3 deals, you could go into what we call a debt fund, a fund that has, like in the worst, we have over 1,500 loans that we've serviced in our debt fund. Okay. We have hundreds in there right now. And so instead of being, you could place $200,000 into the debt fund, and now you're diversified over different borrowers, different markets, and different deals. You get greater diversification as opposed to taking that same $200,000 and trying to source your own funds and and then place them into servicing. It's like buying individual notes is like buying your own individual single family houses. Going into a note fund is like buying, a larger institutional multifamily deal with multiple streams of income. Okay. If you have further questions about that, feel free to reach out to me directly or, ask follow-up questions, because I think that's a great distinction that people, often miss. Okay, great. I'm glad that helped a lot. Considering the probable upcoming interest rate drop, is it better to exit out of debt positions than go into equity positions? Okay, so this is where I have to go back to, like, this is just education, right? Not advice. Here's the thing. When those cycles, wherever nobody's going to be able to wake up, tomorrow and say, recession over. Okay, let's all like drop our debt and go into equity. If we did, we would be like bazillionaires. Like that would be so amazing. Okay. The best investors hold positions in both sides. Okay. I have asked this question to our own wealthy investors, here at passiveinvesting.com. I've asked, interviewed other investors. I've interviewed them on stage and panels at conferences. Every single one of them just goes, I wish I had that crystal ball. So what do is that they invest in the part of the cycle that the market is giving them. And as they move through a cycle, they eventually end up with a more balanced portfolio. Okay, so if you're entering now, and then let's assume 2025 is the year that equity investments come back online, I would still consider having some debt investments, okay, that produce that stabilized cash flow. Okay, maybe it's where you tier your emergency funds. Maybe you tier that money that you need to pay a consistent bill. Maybe it's a kid's school tuition bill, be it a private school or a college. For me, like I have enough note income coming in from all of my note investments that cover like all of my expenses. Okay, so it allows me breathing room and permission to go into other equity deals, because even if those equity deals, they have hiccups or, distributions pause or whatever, if we hit that kind of downside of the cycle, I'm still financially free, right? Okay, now don't take that as investing advice. Okay, I'm probably in a very different investing phase than a lot of people that are listening here. Be it maybe from net worth or from age alone. Somebody who's much younger than me, might be all about going into equity right now. Somebody who's much older than me, that's like at the age hitting retirement, that has different needs. They might be taking all their equity chips off the table and just putting it all in debt. Okay, so there's a lot of color here. If we were playing a perfect market game, if you could get somebody to say, hey, we're exiting the recession right now and we're going into recovery and expansion, potentially that might be a good call. But the thing is, that's going to be location dependent, right? Like, a state in the Southeast is going to recover very differently than a state in the Midwest. It's going to be asset dependent too, and asset class dependent. Okay. Would you say interest rates are helping cap rates become better? And if so, is that positively affecting syndication deals? When the interest rates in theory, when interest rates drop, we were probably going to see some sort of cap rate compression, which means that'll help the valuation of assets, in theory. Okay. So I think that's what we're all kind of like looking for, is for that trade to start happening again. I think what's going to help, syndication deals is going to be supply demand. As we start again seeing that recovery into that expansion, there's more and more competition. I think that's going to help as well. What is late cycle referring to? Heard this term a lot in media lately. Late cycle. Okay, again, we're getting more into like a market type presentation. Okay. Late cycle is going to be like, again, it depends on how it's used. I've seen one like, economic firm, for lack of a better word, use it as like we're heading into the recession already. I've heard it, used like by Marcus and Millichamp and Colliers and Cushman and Wakefield more as we're in hyper supply. But late cycle means we have peaked and we're somewhere in that hyper supply into the recessionary part. Okay, that's usually what late cycle means. For your Alliance fund, it says preferred return of 11% and IRR 20 to 30. Can you speak to the differences here? Okay, so on the Alliance fund, again, remember preferred equity. If you're just kind of like, oh, I want to get some equity, I'm willing to take on, the risk that's associated with being in those, in higher layers of the capital stack. But I want to be right behind the debt. Okay, that's where preferred equity stands. Okay, now preferred equity, if you go back on YouTube and you watch my preferred equity presentation, preferred equity, there are so many different flavors. To be conservative, you would like to see something that has a pref return to it. And then on top of that, you get if you can get a GP kicker. So the 11% is actually the preferred equity position. That would be quote unquote, instead of saying like that operator going to the bank and getting a secondary loan, or a mezzanine loan, they insert a preferred equity tier. It can be upon like the actual close of the asset, or it can be, later on, they put in a second loan position or the preferred equity tier. And essentially that would be paid at 11%. Okay. Quasi like a note, but it's not a note because you're in equity. Now, where a lot of these preferred equity deals are adding juice to the deal, okay, is they're especially, remember, as bank debt evaporates, okay, that means we get to take advantage of the hypersupply and where debt money exits. And so operators of preferred equity funds then can say, hey, we'll bring you a preferred equity layer to your deal. We'd like it. And we would like to have a little bit of that back end general partnership ownership. So when your deal sells, we're going to make everybody whole with that 11%. And then maybe they negotiate, say, 5% of the GP equity as part of the deal as well. That boosts the returns to investors upwards into that 20 to 30% IRR range. So for the Alliance fund specifically, the 11% is the preferred return. And then how we get to the 20 to 30% IRR is because part of the GP has been negotiated on behalf of the Alliance and goes to the Alliance fund. Okay, so the operators are giving up part of the GP to go to the investors in the Alliance fund. All right, second part of the question. With a 3-year hold, wouldn't the IRR be 33%? Well, if we executed perfectly, okay, so hold on. Preferred return of 11%. It's not an additive return. So it's a cumulative return. So the ARR would be different than the IRR. So internal rate of return. So the math would be a little bit differently. So I'm wondering if you're adding 11%, 11%, and 11%, and the ARR would then be 33%, sure. But but the IRR takes into account whenever you get your capital back. And then, so I don't think, yeah, we're not at 33%. So again, if you guys haven't seen the calculation for IRR, it's a big calculus calculation, okay? But hopefully that helps. All right. I don't have any open questions right now. If you guys have an open question, this is a great time to jump on over to the chat box and put it in. All right, guys. Well, I hope you have a safe and sound Labor Day weekend. We will see you next week. We're going to be talking about required minimum distributions and the 3 ways to get those invested. You know, three things you can do to get those invested before the end of the year. This is geared towards retirees. However, if you don't understand what a required minimum distribution is, if you're approaching retirement, this is going to be a great webinar so you can start laying out your plan as you go into retirement. So join me next week for that. I'll hang out here for another minute for any last minute questions. And otherwise, everybody have a great Labor Day weekend, and we'll see you next week. All right. Everybody take care. Oh, hold on. See another question. What are some of the good books or websites for debt investing? There's a book called, well, I mean, so I've got one on my book, Lend to Live. I haven't finished it, to be perfectly honest. That's a book that Bigger Pockets put out, but that's going to be more about sourcing your own notes and building a portfolio of individual notes. But most people have a higher and better use of their time. You know, you could source your own individual notes. It takes time. Okay, so you got to factor in your return on your time. You might be able to, you know, get, you know, somewhere between 10 to 12% for the note, and then you're going to, you know, get, you know, the closing fee and stuff like that. But then you're going to have your own expenses, like with accounting and taxation, servicing. You're going to have to place it with the servicer. And so long story short, that's why I really like note funds. And to underwrite a note fund is a lot like underwriting a just a general syndication. And there are videos on the passiveinvesting.com web YouTube page where I go through how to actually underwrite debt funds. And so I go through, because whenever you're underwriting a debt fund, you have to underwrite not just the syndicator, whoever's raising the capital, you need to actually really know who's deploying the capital too. So in the case of passiveinvesting.com, you would underwrite passiveinvesting.com as the people raising the money, but you would also underwrite Rehab Wallet, which is our vertically integrated lending arm of the company. And sometimes they're not vertically integrated. Okay, so that's why you have 2 people to underwrite. Okay. So those videos, I think, would be the best videos if you're looking to actually get into debt fund investing. If you're looking to actually build your own portfolio of single notes, check out Lend to Live. That might be a good option for you. Awesome. All right, guys. I think we've got the chat box cleared. Everybody take care, and we will see you next week.